Hi, my name is Maricruz Santana, and we are team number 5. We are doing this presentation on assignment number 1. I'm going to explain how to calculate the company's predetermined overhead rate. Um, the first thing we do, we get the budgeted manufacturing overhead dollars, which in this case is 462,000, and we divide it by the budgeted direct labor hours, which in this case is 21,000. I should also say that the $462,000 is also considered a cost object, and the budgeted direct labor hours would be considered a cost driver. After the calculation, we get a predetermined manufacturing overhead rate of $22. We also prepare the journal entries to record the events of October on the input worksheet, which we transferred over to the input sheet. Now Mike will talk about the T accounts.
Hi. So as Marie explained before, the T accounts are linked with the input sheets, the journal entries in the input sheet, and then also we use the various functions, Excel functions like sum functions to come up with the balance of the T accounts, and also we use if statement to, for example, for overapplied and underapplied amount of overhead, we wrote in the if statement into the form into the cell. So if the amount is higher than 0, then it will take the balance into a different cell than when it is lower than 0. And then from that point on, we're done with the T account sheets, and then Shannon will tell you about the overapplied and underapplied amount of overhead in the next section of this video.
I'll talk to you about the over and under application of manufacturing overhead in the project. What we did is we took our MOH control account in our second tab, the T account tab, and we summed the entire debit side, and then we subtracted the sum of the entire credit side and came up with the difference, which of course was a credit balance of 3,190, which of course is over applied MOH. So we took that number and we fed it back into our journal entries as an over application and wrote it off to cost of goods sold. But we also created a second journal entry and a second if statement so that we could drag in, if it was a debit balance, it would go into a secondary journal entry, so it was prepared for either eventuality. The second thing I'd like to talk to you about is the cost of goods manufactured. We created a independent tab for the cost of goods manufactured schedule, and we populated it by bringing in the amounts from all the T accounts directly into the schedule so that we had all the direct labor, direct manufacturing, material costs, and then of course our MOH costs, all of those listed out to get to our cost of goods manufactured, and it would just automatically link in from the T account amounts and then give us a total for the cost of goods manufactured, which we could then use in our cost of goods sold schedule. And Daniel will be talking to you about that.
So I'll talk about how we came up with the cost of goods sold schedule. Basically, we linked all of our worksheets together, so it automatically populates each one of the schedules. So for the cost of goods sold schedule, the beginning finished goods inventory and the ending finished goods inventory are populated by are linked by the T accounts worksheet, and the cost of goods manufactured is being pulled from the cost of goods manufactured worksheet. So we came up with a positive amount of $32,290 for cost of goods sold, which in turn automatically populates the income worksheet, which I'll talk about next. So as for the income statement, the revenue is being pulled from the T accounts worksheet, and the cost of goods sold is being pulled from the cost of goods sold worksheet, which gives us a negative gross margin of 4,930. Now we need to take into account of the operating costs, which are all being pulled from the T accounts worksheet, and which totals a negative operating income of $24,080. Now that concludes our presentation. We're Team 5, and thank you for your attention.